In this video, I'm going to show you how to decode your loan estimate like a pro. That 3-page estimate that you got from your lender holds all of the answers, but only if you know how to read it. Luckily, you found this video. We're going to use a foolproof tool to help you analyze your loan estimate and understand the fees. When you're done watching this video, you're going to be able to spot red flags, compare quotes like a pro, and make the smartest move for your money. Okay, here's the tool that we're going to use. This is the Loan Estimate Explainer on the CFPB website. It's linked in the description if you want the direct link, or you can just Google Loan Estimate Explainer and go to the CFPB website. So here's what your loan estimate will look like. This is a standard mortgage loan estimate document. So no matter what lender you pick, it's going to look like this. So it'll be easy to compare lender to lender. And you'll see your lender listed up here. So what's really cool about this tool is it has orange and pink boxes. So the orange boxes will show you the action steps that you need to take when you're reviewing your estimate on each page. And then the pink boxes will show you definitions. So any words that you're not sure what they mean, it'll have the definition here. So we'll start up here with the first box, which they just tell you to check your name. Just make sure the spelling is accurate. Make sure if you need to make any updates here that you do so in the beginning of your process. Just makes things a little bit easier. Don't want any last minute changes holding up anything. Second box, you want to check your loan term. Make sure that you have the correct term that you want, and this will list whether it's a purchase or refinance. It'll tell you whether it's a fixed rate or an adjustable rate, which is really important to know, as well as your loan type, whether it's conventional, FHA, VA, or a non-QM loan. In this case, it's conventional. This box right here will tell you if your interest rate is locked in or not. And that is essentially meaning that the pricing that they're offering for this interest rate, which is listed on page 2, is locked in for your loan term, so it won't change. Now, interest rates do, and the pricing for interest rates moves with the market. So they move up and down, sometimes multiple times a day. So that is important to have that conversation with your loan officer to figure out if you want to lock your interest rate in. Sometimes they'll float it and try to get you a better deal, but that doesn't always work out if the market's super volatile. So it's definitely something that the loan officer should discuss with you, and you can make that decision with them whether you want to lock your rate in or not. And if it is locked in, it'll tell you it's locked in right here and what date the rate lock expires. So once that rate lock is expired, this pricing for this interest rate is no longer available. So it's going to be based on market pricing at that point. It's also important to note that if you're comparing loan estimate to loan estimate, to check whether either of the loan estimates are locked, because if it's locked, that pricing is still available. If it's not, the pricing has already changed with the market. So you want to get real-time updates from the loan officer and see what their current accurate quote is. This next box here just has you checking that the loan amount is correct, and the way you can check that is check that the sales price is correct here. Make sure the address is right as well. Sometimes that gets messed up and that can cause problems. But check the sales price here and then subtract your down payment, and that should equal your loan amount. This box is just telling you the interest rate you have on your loan, and then it's telling you here, it'll let you know if this can increase. So if you have an adjustable rate mortgage, this is going to tell you, yes, it can increase. This one is fixed, so it will not increase. It'll stay this for the life of your loan. Here will tell you what your monthly principal and interest payment is. And this is important. It'll let you know if you have a prepayment penalty on your loan. So this particular lender does have one. So you'll want to know if you decide to pay off your loan early or you refinance within a certain time period, if you have to pay an extra fee for that. Same with balloon payment. That's an additional lump sum payment at the end of your loan that you have to pay. So you want to know if you're going to have to pay that down the line. Moving down to this box, this will just break down your total payment. So it'll include your principal and interest, if you have mortgage insurance or not on the loan, and then what your escrow payments are. So in this case, escrows are estimated at 206. These numbers do change if they are not accurate. So most lenders will try to give you a really solid estimate up front, but sometimes those numbers aren't accurate if they confirm that the taxes are higher, or sometimes they come in lower, or your homeowner's insurance hasn't been picked out yet. They'll need to adjust those figures once they get those numbers verified in underwriting. So this here will give you your total estimated payment with your principal and interest, mortgage insurance, and your escrow. So this is your total monthly payment that you'll be making to your servicer. Now this box here just breaks down what is entailed in your escrow account. So here we have your property taxes and your homeowner's insurance are in an escrow account. That just means you're making monthly payments into your escrow account to cover those property tax bills and the homeowner's insurance policy bill when it comes due again. So your servicer will take care of those payments on your behalf. You don't have to worry about it. You're just putting money into that escrow account to make sure they get paid. If you have any HOA dues on the property, they're not going to be in your escrow account, but they will mark it here as other, just to let you know that there are other expenses on the home that are not included in your monthly payment. So that's something you'll have to take care of outside of your mortgage payment. All right, estimated closing costs. This is with your initial loan estimate, it's definitely estimated, and they're broken down on page 2. So we'll go over that in a minute. But this is just basically estimating what the upfront cost is to obtain your loan. And then estimated cash to close is going to include all of your closing costs plus your down payment. So this is the figure that you are expected to bring to close. Now, again, these are just estimates. As you go along in the process, more numbers get verified. If you decide you want to make some changes, those get updated, and you'll get updated loan estimates and disclosures throughout the process. So you'll eventually get a final closing disclosure that you can review before you go to closing to make sure all of these numbers are accurate. Okay, now we're on page 2. And something I want to note is that section A is going to be the most important section when you are comparing lender to lender. All of these other fees, except for the lender credits here, are going to be the same no matter what lender you go to, or similar, the same or very similar. But section A is going to be how you compare apples to apples from each lender. So we'll just go over these fees here. Origination charges is basically just the fee that the loan officer or broker is charging you for doing the loan. And then points, this is a charge to get a lower interest rate. And application fee, some lenders may or may not have this. Underwriting fee, that's pretty standard. You might also see processing fees on here. So admin fees, sometimes different lenders have different names for fees. But essentially, what you'll want to look at is what the costs are associated with the interest rate that they're presenting to you. And if you're comparing two lenders, you want to make sure you're comparing the same interest rate, because they're going to each have different fees for that particular interest rate. And what usually happens is you'll get an initial loan estimate from a lender that you're working with. And if you have a competitor come and tell you they can beat that interest rate, that's very true. The interest rate's going to be available, but what you'll want to look at, say you have a 6% on this particular estimate, and you have a lender come say, oh, I can get you a 5.875. Make sure when you get that estimate from the competitor with that 5.875, you look at this section and see what they're charging you. Because you might look here and say, oh, they're charging me $5,000 for that 5.875, and this lender had a credit for the 6%. But you'll also want to go back to your original lender and ask them what their pricing is for 5.875, because every lender can get all the same interest rates. It's just the pricing for that particular interest rate that's going to change. So you want to compare apples to apples and make sure you're comparing the same interest rate with each lender so that you can see what fees they're charging for the same interest rate. That way you're comparing apples to apples. So this box is what matters, and then this lender credit, because if you're not getting points charged on a loan, you'll likely have lender credits. And this is a credit that'll come back to you to help pay for closing costs, and it'll lower your cash to close. So if that's something that's important to you, you want to discuss what lender credit options are available, and you can compare. Does it make more sense to do a higher interest rate, maybe have a slightly higher payment, but way lower closing costs? Those are all options you want to discuss with your loan officers so that you can figure out what makes the most sense for what your needs are. Section B is services you cannot shop for. So this is going to be lender required items that you can't negotiate. They should be very similar lender to lender. They might vary a little bit in certain fees, but they should be pretty standard. Section C, services you can shop for. You can shop for title insurance. If it's a purchase loan, you might need to negotiate that with the seller and the agents. But if it's a refinance, you can just go as a consumer and go out and shop different title companies and let your lender know which title company you want to use, and they'll verify those fees and get those updated for you at later disclosures. Same with pest inspection or any surveys. You can go out and use whoever you want for that, and then send your lender the invoice, and they will update the numbers on your estimate and on your final closing disclosure. Other costs. Okay, Section E, this is going to be the same no matter who you use. Same with Section F and G. But Section E is the fees from the county, so that's going to be the same no matter what. Prepaids and initial escrow payments at closing. This is based on your close date, the interest rate you pick, and then what your homeowner's insurance premium is and what your property taxes cost. So some lenders may disclose this different ways, but in the end, they're going to calculate it exactly the same. And no matter what lender you use, these numbers are going to be exactly the same. So don't even look at these sections when you're comparing loan estimates. Now, section H, you'll want to, this is going to coincide with the title fees here. You'll want to talk with your escrow agent about this and see if you want a title policy, but it is optional. And then again, lender credits, you'll definitely want to check on those. And if you do have a lender credit, it's going to get deducted from your total closing costs, because this is the total closing cost listed on here in the total. And then if you have a lender credit, it'll get deducted from this number. Now, moving down to calculating cash to close, this is a really cool box because if you're confused on how they came up with that number, this breaks it down for you. So if you do have a credit, the credit will be deducted from the closing costs here, and you'll have the deducted number here. So you'll have the actual accurate number here. And then any closing costs finance, this would be like upfront mortgage insurance if you are getting an FHA loan. If there's something that's wrapped into your loan amount, this will get listed here. Down payment, so that's just the down payment that you're going to be bringing to closing. And any deposits you put down, so any escrow money or any earnest money that you put down already, this will get deducted from your closing costs because it'll get credited back to you. And then funds for borrow, this is like if you had like a grant money, like any grant money or something. Seller credits, if the seller gave you a credit, this will be listed here and deducted from your cash to close. And any other adjustments that need to be made will be here as well. So that's how they'll get to your total cash to close. This is the number that was listed on page 1. So if you have any questions about the number listed on page 1, go to this box, and then all of these fees are broken down for you. Okay, so now we're on the last page of your loan estimate. So this first box up here just tells you to check your loan officer, make sure the person that you believe to be working with, make sure that they match. And this is all their contact information and their license number as well. And then this little section is good to compare lender to lender, kind of tells you the costs associated with your loan and how much you're actually paying for your loan. So there's some interesting figures in there. And if you look here, there's tons of links to learn a little bit more about these figures. And one of them, the APR, how to look at the APR. So your APR is basically your interest rate factoring in the cost associated with getting the loan. So it kind of tells you like your true rate given your closing costs. So here it kind of gives you a link where you can learn more about this. And then this just tells you, helps you understand how much interest you're going to be paying over the life of the loan, which is important to compare with different loan options. This is an important box, late payment. This will tell you what happens if you make a late payment. So it'll tell you what the fee is associated with that. And here's some other considerations. The appraisal, this will just tell you if an appraisal is required or not. Most programs are going to require one. Sometimes you get a waiver, but most of the time you'll need one. Assumption, this just tells you if someone can assume your loan later. So that might be something you need to know if the buyer of your property is trying to assume it. And then loan servicing, this is important to know because this will tell you if the lender you're using intends to sell your loan to a new servicer after closing, which happens probably 98% of the time. So most of the time your lender will sell it to a new servicer, and that's important to know because after you close, before you make your first payment, you'll likely be hearing from your new servicer and who you're supposed to be making payments to. So that can change at any time. If you get any notices in the mail, pay attention to those and make sure they're legit as well. You can always call your loan officer to make sure that they're accurate. But you'll need to keep paying attention to that so you know exactly where to send your payments. And this is the bottom of page 3. I did want to go over this because I get questions on this all the time. So when you get an initial loan estimate sent to you with all of your other loan disclosures, that is something that's required from lenders and loan officers to send out those documents and all the disclosures to give you all of the information you need up front to know what you're getting into. But when you sign the initial disclosures and the initial loan estimate, that does not mean that you're agreeing to the loan or that you're obligated to the loan or you're agreeing to the terms. It just means that you received the documents, you acknowledge that you received them, and that the lender did it within the appropriate time frame. So signing this is required in order to move your loan into underwriting and processing, but it doesn't mean that you're going to be closing on it or that you're obligated to anything. The only time you're obligated to anything you sign is if you sign at closing with a notary, and you'll know when that's happening. So all of these documents during the process is just disclosures so that we can stay compliant, make sure that you're informed as a consumer. So just wanted to note that it does say that here too. By signing, you're only confirming that you have received this form. You do not have to accept the loan because you have signed or received this form. So keep that in mind. Just signing this keeps your loan moving, acknowledges that you reviewed it and you've received these documents. So that sums it up. That's the end of page 3. So definitely lean on this tool when you're reviewing your estimate. You can have your loan officer help you go through it as well. I suggest utilizing your loan officer as much as possible and utilizing this just for your own education, because this has a lot of great information and it's a good reminder of something to follow along while looking at loan estimates. If you want to learn more about the home buying process, you can download my free Home Buying 101 workbook with the link in the description. And if you like this video, please like, subscribe, and ring that bell.